Good morning or good evening, depending on where you're joining us from. We're going to go ahead and get started. So welcome to a webinar on the rise of pay-as-you-go smartphone finance. We're very fortunate today to be joined by a representative from PayJoy, who will discuss the organization's work expanding access to smartphone ownership through innovative financial solutions. And we'll go ahead and we're going to start today's webinar with some quick introductions and a bit of context setting before handing things over to PayJoy to talk a bit about their work. Just a note, we will save some time at the end of today's webinar for a Q&A. You'll notice on the right of your screen that there is a chat box. Please, at any time during the presentations today, feel free to go ahead and submit your questions using that chat box. Be sure to address those comments to everyone, and we'll go ahead and compile those as we go, and we'll be sure to address them at the end of the webinar when we get to the Q&A. Some quick logistics before we start today. So this is an audio broadcast, and we will have your microphones muted throughout. Again, you can ask questions at any time using the chat box, and we'll keep an eye on those and make sure that we get those answered towards the end of the webinar. And again, please select all participants when you do submit your questions, just to make sure that everyone is able to read them. And just a quick note that you can access a recording of this webinar. We'll go ahead and send that out via email to the address that you provided when registering. And please also feel free to share that with your friends and colleagues who might not have been able to attend today's session. So just some quick introductions. My name is Max Mattern. I'm a financial sector specialist here at CGAP based in Washington, D.C. My work at CGAP focuses on innovations in financing for assets like smartphones. So this has been a topic that's quite near and dear to my heart. And we're also joined by Tom Jaynes, who is PayJoy's Business Development Director, focusing on OEM relationships globally. He's been with PayJoy since 2017, and previously he worked in financial solutions at Brightstar, which is a SoftBank company, and also with Western Union, where he managed the Central American territory, among other roles. He also has experience with consumer marketing with GlaxoSmithKline, and has had several international postings in Latin America and Europe. Currently, he's based in the Fort Lauderdale area of Florida. Just diving in, so why is it that CGAP is interested in financing for smartphones? Well, first of all, smartphones are an incredible opportunity to narrow the digital divide. So 2 billion people globally right now are using only a smartphone to access the internet. I think that really underscores the importance of these devices for creating access to the information economy. But at the same time, despite the importance of these devices, penetration is really lagging behind in many less developed countries. So right now, only about 34% of Sub-Saharan Africans have access to a smartphone. And in many countries, the cost of the cheapest entry-level smartphone is over 50% of the average monthly income. And looking at the poorest quintile of households in Sub-Saharan Africa, it's actually 375% of the average monthly income. And in South Asia, 269%. So that really underscores the fact that despite the importance of smartphones, it's incredibly difficult to afford these upfront, and therefore financing may offer an important option for customers, lower income customers, to amortize the cost of smartphones over time. At the same time, what we're seeing at CGAP is that innovations in technology, in business models, are actually unlocking new options for financing assets like smartphones. Traditionally, asset finance has been tricky when it comes to lower income populations because of the cost and the risk of serving them. But what we're seeing increasingly is solutions like remote sensing and digital payments unlocking new innovative business models that overcome some of the obstacles to serving customers at the base of the pyramid. And those new business models, things like pay-as-you-go, are actually expanding access to asset finance products. When we say asset finance products, we're talking about loans, leases, rentals. And so that is what has led us to this new inclusive approach to financing smartphones that's actually using the same approach that we first saw for financing solar home systems. And so this is just one type of low-value movable asset that you can use a PAYGo approach to finance. And so the technology, so this would include digital payments, the ability to remotely lock the asset in the event of non-payment, actually allows customers to qualify for financing they would otherwise be unable to access. And it also allows the financing to include kind of flexible repayments, so where you're actually able to pay little by little to obtain ownership of the asset, and do so in a way that more matches your cash flows. And this also helps lenders to manage risk by removing the need for kind of the physical collateral and repossession of the asset. So without further ado, I want to hand things over to Tom, who will talk us through PayJoy's global work on financing smartphones. Tom, over to you.
Thanks very much, Max, and thanks everybody also for joining this morning or evening, wherever you may be. And Max was mentioning the pay-as-you-go solar approach. I think that's a great segue into PayJoy, because our founder, Doug Rickett, spent some time in Africa, first in the Peace Corps and then working with an electric company. And as actually a pioneer in the pay-as-you-go solar, he had this experience where they were looking to sell these battery units to these households in rural areas, and folks couldn't afford the $50-ish for the unit. They came up with a way to finance, and then found that there was an issue with consumer default risk. So he wrote some code to be able to simply shut off the lights if a payment was missed, and lo and behold, the consumer default risk fell substantially. And the thought process from Doug was, when he came back from Africa, came back to go to graduate school, what's the next most important asset that folks who are underbanked, don't have access to credit, need access to? And of course, the answer is smartphones, for all the good reasons that Max had told us about or reviewed a little bit earlier in the introduction. Thank you for that as well. So I'll go over a quick agenda, our overall vision and value, and an infographic we've put together, talk a little bit about the PayJoy app, which certainly has the lock among other features, some case studies to show where it's working today and how folks who might be interested to engage with PayJoy can work with us. And I'll be happy to take all of your questions as well. As wanted to say, took a quick look at the invitee list. I see a number of old friends as well as new, so happy to have you all with us. It's an honor to be here presenting with CGAP today. So let's talk a little bit about PayJoy's vision and value. And as we know, the problem leading in the developed markets, there aren't credit systems, or if there are credit systems, they're not inclusive, or they're simply broken. And PayJoy has a way, our solution, to bring together an app which has a locking solution, which can also be combined with our alternative credit decision-making criteria, to bring together a very powerful solution to enable those financial institutions, be they banks, fintechs, etc., to come to the market and service this consumer segment, which heretofore was considered far too risky to serve. And I will bring your attention here, of course, as we talk about the base of the pyramid. We know that the postpaid market, which is typically aligned with those that have credit, are very well served. Regularly, those consumers who regularly sign up for prepaid plans are not quite so well served. And we know that if we can unlock access to them, all kinds of benefits happen with the value chain. Certainly with the consumer, they gain access to the smartphone that they wouldn't have had ordinarily. They also, in terms of an MNO, you will see reduced churn, and you will also see an increase in ARPU as people graduate from feature phones to smartphones. We could talk a little bit about that PayJoy effect later. And then, of course, for OEMs, the smartphone brands themselves, they typically find themselves selling a bit more of a higher value brand, because once the consumer gains access to finance, they don't have to go with the entry model. They can go with a more valuable, more useful model, potentially, that maybe has other features. The tactile approach is different, etc. So the OEMs will find themselves selling a higher value device, and of course more of them increasing their market share. So it really there's incentives all over the value chain for providing this kind of finance to this previously underserved consumer segment. And this is an infographic that we've put together. As infographics are, they've got a lot of information on them. I'm going to just pull out 3 or 4 different points to speak to. The first one is towards there in the middle upper left. It talks about the effect of PayJoy's solution on consumer default risk and how effectively we mitigate that consumer default risk. We have seen that our alternative credit decision-making criteria, when used, is 3 times more predictive than your standard credit bureau type of information, your legacy credit bureau type of information in the markets where we're working. And that, of course, is extremely powerful. But as well, and importantly, the app, the locking app itself, just by itself, tends to have a 50% reduction in consumer default rate. And not really captured here in this 50% reduction, but the other effect that it has is it tends to smooth out the peaks and troughs that one might normally see in a portfolio as it matures over a term. So those are important criteria to keep in mind. You're reducing your consumer default risk by 50%, and you're making it more predictable over term. These 2 things brought together give financial institutions the wherewithal to address this market and be able to forecast it relatively well. There's certainly still adjustments that need to be made, but they have seen, and we have seen repeatedly over time, a fairly consistent drop in 50%. Frankly, we've seen some more, which is also encouraging, but 50% is a good average number to use. The other topic I wanted to mention was one that I touched upon a little bit before. We have seen that brands, OEMs as an example, are able to increase their average selling price by 33% in the areas where PayJoy is present. And it has to do with that tendency of the consumer, once they have the ability to get not just an entry-level smartphone, but a smartphone that may be 1 or 2 tiers above, reaching the $200 average more or less. That's going to change between markets. That's a good number to use. That's a very good device, $180, $200. That's a very pleasing user interface. As an example, it's not clunky, and so folks will be able to use it more easily, and the whole quality of experience is important there. And the last thing I wanted to touch upon on this page is our Net Promoter Score. I'll pause there for a moment and say that PayJoy actually lends its own money in Mexico. We chose Mexico as our lab, if you will. Why Mexico? Because it's a large economy. It's certainly a developing economy. It's got a number of different tiers in terms of the cities and the rural sections, and that are a good model for the rest of the world. But also importantly, Mexico ain't easy. In this segment, addressing the underbanked consumer segment, there are a number of very well-developed consumer offers to provide for microloans and consumer lending. And we have seen our ability to compete in that competitive space very well. So it makes us feel good about going to other markets that maybe are also competitive, but also those markets which haven't yet developed these offers to this consumer segment. And one of the things that we've done is that we've shown that our methods of mitigating consumer default risk are so effective, and our lock is so user-friendly and so effective in driving the kinds of behaviors that we're looking for, that we find we're doing much better than the competition simply by virtue of the fact that we have no late fee. So if a consumer misses a payment, there's no punitive fee or fine, if you will, for having missed the payment. The phone simply locks. Certainly, the phone can be used to dial emergency services or to call the lender, or typically to call where the store is purchased. But the phone simply locks. You'll see the screen, the normal Android screen, you click on one of your favorite apps, and it just comes up and says, you owe money to PayJoy. And we have found that this approach, perhaps counterintuitively, has driven a great deal of gratitude among the consumer base in Mexico. And we find that we got an 80 net promoter score recently. And if you compare that to some of the other scores in the market from different classes of trade, you'll see scores in the 30s and the 40s and even lower. So we believe that we compare very favorably to our competitors in this market, but more importantly, we see this as a sign of gratitude that this consumer segment, we know on this call typically that cash flow is not predictable for this consumer segment. So the PayJoy model has found a way to meet those consumers where they are, to acknowledge the fact that they have an unpredictable cash flow and still be able to find a way to enable PayJoy itself and, of course, PayJoy's partners that license our technology elsewhere to address this market. So I will switch over to another slide and answer the question, which markets are we in? And we're painting the world green here, one country at a time. You can see that we're in a number of places in Latin America, Mexico, Guatemala, Honduras, Panama, just launching now in Colombia and Ecuador and Brazil. And we are in a number of countries in Africa, Senegal, Cote d'Ivoire, Nigeria, Kenya, Tanzania, Zambia, South Africa, and just launched Madagascar, Pakistan, India, Indonesia, and Malaysia as well. And the next slide talks a little bit about the lock. And here I will show what the lock looks like on the phone. So if you would imagine an Android system and perhaps woken up in the morning and you haven't paid, what would you see? You'd pick up the phone and you'd see the normal home screen. But if you went to go tap onto WhatsApp or perhaps your pictures or something along those lines, the camera, the music, this is the image that you would see pop up onto the top of your screen above all of the other apps. And it says you need to come and pay for your loan. And there's a number of things there that are important because there's a way to get help and there's a way to pay. Now in Africa, where we've got a lot of mobile money options, as an example, there is an in-apps payment option, and in-apps payment options can always be linked into the app. And in those markets where this consumer segment has access to those kinds of instruments, then that certainly facilitates payments. And in Mexico and in some other markets as well, where those electronic payments options aren't available to this consumer segment or don't yet have a very high penetration, it tends to be cash. And so what will happen there is a map will pop up in front of you to show you where you can pay cash for your installment. As an example, in Mexico, you can pay in the OXXOs of the world. I think there's over now 70,000 places where you can make a payment on a PayJoy phone. The important thing also here is this is a very strong lock, right? It's going to survive attempts to hack it. And you will see, and maybe some of you already have done this, if you go onto YouTube, you'll see people who are trying to offer to remove the PayJoy lock. We follow up with all of them 9 times out of 10. They're fraudsters looking to defraud fraudsters. It just doesn't work, and we have the ability to patch this over the air should a vulnerability be found. The important point is that hacking has never been an issue for PayJoy on our own money. It's another good reason why we're in Mexico with our money where our mouth is, as I say, because it certainly aligns us to our lock strength and certainly makes the financial institutions that are lending money against the license of PayJoy technology and know-how also helps them feel comfortable with the lock's strength. And that requires some coordination with smartphone brands, OEMs, and actually what I do principally. So how does it work at the point of sale? There towards the upper left-hand corner, we've got our start. Typically what happens is a consumer walks into a store with a certain amount of cash on hand, thinking that they'd typically buy a feature phone or a hybrid phone of sorts, or perhaps a very low value smartphone, $35, $40, etc. The clerk will see that they're looking to make that purchase and will offer to them the ability to make a down payment on a much nicer phone, qualifying for finance with PayJoy. And oftentimes there's a little bit of resistance there. The consumer says, no, I don't have credit, or I don't have access to credit, or no, they always turn me down. And we find that we are able to make an offer to these consumers 90% plus of the time. And we are able to do so with very lightweight underwriting criteria. So we will ask them to come to a tablet, and we'll ask them for a phone number. It doesn't have to be their own, but it can't be the salesperson's. A Facebook account, and a valid government ID. Only those three things. We don't have a home visit. We don't ask for pay slips. We don't ask for bank accounts. We don't ask for a bill coming to your home address. We only need those three things: Facebook, valid ID, and a phone number to do an SMS check. And on those three criteria alone, we're able to make an offer to 90% of people. Let me pause there and hasten to add that we do not make a credit decision based off a Facebook account. It's much more for other reasons related to fraud checks, but it is not the criteria by which we extend credit. That's Magic's, what do they call it? Special sauce that's on our solution, but it's not based off of what we see in Facebook. So with those three very lightweight criteria, we approve people 90% of the time, which in itself is a surprise in many cases. And so what happens then is the consumer agrees to the terms and conditions. The clerk pulls down the PayJoy compatible device. They set up the phone and they install the app. The app itself will then produce a 6-digit alpha code, which is then input into PayJoy's point of sale system, which is a software as a service system or web service system. The app then turns green and the consumer can use the phone. And they walk out of the store, and whatever their payments cadence is, a week, a month, etc., they come and making payments, and hopefully, and many times, they never miss a payment, and then that's fine. They can remove the lock at the end of term if they'd like. Other consumers, perhaps the more usual case is that occasionally they miss a payment for whatever reason. It doesn't matter. And the phone locks. Maybe it locks for an hour, maybe it locks for a day, maybe it locks for a week, maybe it locks for 2 or 3 months. It doesn't matter to PayJoy. Come back and pay us, and you start your loan cadence again from that point. And again, in the PayJoy model in Mexico, we've shown that we don't need to have late fees in order to be profitable in this segment. So that's an important criteria, as I had mentioned before. Now, at the end of the term, the app can be removed, and conceivably the app can be kept there as well if the consumer wanted to ask for a microloan, if you will, against the value of the phone or against the value of their good payments history in the past with PayJoy or PayJoy partner. We're beginning to experiment with that sort of thing now. Of course, another thing they can do is they can come back and get another phone, and many times they do. Started to measure that. We've seen 15-20% people come back and get another phone with us for another person in their family, as an example. And I think, this is maybe a little bit of a repetitive slide, and I will just go down to some case studies now to show where we are and how this works and the effect that it's really having, especially on sales channel, which also not only speaks to the ability of the business model, but also the consumer acceptance. So if you look at this retailer here in Eastern Mexico, for those of you that don't read the Spanish, it says celulares en crédito. That means cell phones on credit. That's all PayJoy. And this chain, which it says here 130, actually 140 stores now, it's a sizable chain, and they saw a 100% increase in their growth in same-store sales of smartphones after launching PayJoy. So certainly a very substantial growth in their business. They had said beforehand they were really relying on accessories to keep the business going in terms of margin, and now they've found that they've gotten not only a 100% increase in their unit sales, but they've also increased their ASP, their average selling price, by 33%. Another example of a large Latin American carrier, they halved their default rate. Now, again, we see that 50% figure. This is close to having that in the rate. They beforehand were loaning to this consumer segment, and they saw their consumer default rate at 13% fall to 7%. And not only that, but their repayment rate increased from 45% to 80%. So again, some very profound business effects. This slide here from a Panamanian finance company talks some more about the approvals that the PayJoy solution brings. So beforehand, they were approving 60% of applicants in this consumer segment, and that improved to 90% approval rate. And at the same time, they reduced their consumer default rate from 9% to 4.8%. So you've got an increase in approval rate, more consumers coming in through the door, and you're reducing your consumer default risk. Again, a very powerful combination for a business, and again, testament to the strength of this idea. And I'll close here with one last example, or maybe two more examples. We see from a pay-as-you-go solar company that's now branched into this asset class, a 70% increase in revenue per customer just by expanding their portfolio to this new asset class. And as you see, increasing their repayments rate, which is frankly already high, 90% from solar up to 98% for the smartphone segment. And again, we see some more of these really large numbers, impactful numbers. Another MFI and distributor in Africa and Zambia, increasing their same-store sales by 250%, and their approval rate increased incredibly from 33% to 90%. So again, we see an increase in approval rate, a decrease in consumer default risk, and an increase naturally in same-store sales. And we see this with PayJoy throughout a number of different countries and regions, and even retail format context. So we see that we've got a very profound increase in the ability to address the business opportunities that this consumer market, this consumer segment presents. And we would love to do some more, which brings me to our quick talk on how to engage with PayJoy. Typically, we will speak with a fintech or an MNO. Sometimes the MNO itself is lending. Sometimes no, the MNO is a channel. We naturally have a certain session of information sharing and goal sharing. We come together with a mutual engagement plan. We look to optimize that plan, and then we invite people to come to see PayJoy University up in Mexico to see how things are running, so that they have the tools that they need in order to get all those stakeholders on board inside their organization. Then we look to sign agreements naturally and launch, and we're looking to grow aggressively in 2020 and the years to come. So with that, I will just say that our prices for our licensing is posted on the web. It is here, and we see that it certainly brings the kind of value that, or drives the kind of value that we see needs to be driven in this consumer segment. And I see that there are a number of questions, so I will pause here and see if there's anything that Max would like to talk to while we look over some of these questions.
Thanks, Tom. Appreciate it. A great presentation, and I can see that we're getting a lot of questions in. So we'll go ahead and compile those and start to go over them. But maybe just to start off, maybe I'll just throw you a couple of quick questions. So one thing that's been really interesting for CGAP as we've been looking at various approaches to asset financing has been this question of financing on balance sheet versus off balance sheet. So you had mentioned that PayJoy started out in Mexico lending on your own balance sheet, so not working with a partner financial institution. But your approach has evolved over time. So you mentioned a number of different institutions, MFIs, banks that you're working with globally, where you're providing the technology, so the locking technology, but the actual financing is coming from that institution's balance sheet. I'm curious if you could talk about what the advantages have been to shifting to off-balance sheet lending, and whether you've been running into any challenges working through partners.
Yeah, great question. I mean, if it's more from why doesn't PayJoy run around and set up more finance companies around the world, it just takes a lot longer to do. It's easier to, and much more efficient, I should say, to scale by using other folks' balance sheet, lower cost of capital very typically. And they see that they would like to gain access to this consumer segment, but haven't now, or they tried and got their fingers burned. And and now they see that by licensing our know-how and technology, they're able to do so. So it's a good way to expand very quickly and efficiently to more markets. Setting up a finance company in a number of different markets throughout the world it takes a great deal of time. Other folks already have the necessary licenses and compliance programs and et cetera, those things that are necessary and require time to establish.
Great, thanks, Tom. And just another quick question for you. It regards some of kind of working with the OEM. So obviously your locking technology is more or less device agnostic. I know it's only working on Android phones at this point, but it's not really specific to any particular OEM's devices. And so I'm wondering, one of the things that we've heard in some markets like Mexico is that some of the OEMs are starting to get interested in introducing their own locking technology. Do you see this as something that is a threat to your business, or something where you're offering additional value beyond what the OEMs can offer? I'm just curious on how that's affecting your strategy moving forward.
Yeah, thanks for that question. I see there's an OEM question here too. So it's certainly very flattering, I guess is the best way to put it. What we do see are a number of things, and thinking through the question, I can think of two important things that are good to consider. OEMs oftentimes tend to underestimate what is necessary to put into a lock in the user interface and the back end and the launching with the finance partners and et cetera. And that's a heavy lift. Let me put it that way. We've been doing this since 2015, and we've got the track record that we've seen today, and we see that that's perhaps something that an OEM might look to emulate. But importantly, if an OEM goes to a mobile network operator, as an example, or a retailer, we have found that retailers tend to want to have a solution that is multi-OEM. So they don't want to be over-reliant on one OEM, as an example. And they certainly don't want to be over-reliant on OEM for retail reasons, but also for risk exposure reasons and the strength of a lock. The second thing is that they want to have one tech interface. So if you think of a hub and spoke, PayJoy is a very efficient way to bring a number of different OEMs together on one platform with a lender, as an example. And the lender can, using its own business rules, and again, the back office that we have established, using its own business rules to programmatically lock and unlock phones according to their rules, without having this series of one-off integrations with a number of different OEMs. So we have seen some of that, yes, and for both reasons, I have to say it's not something that's necessarily affected us at the moment in a negative way. Rather, we see it as a way to grow the market, and I can share that I know at least with one OEM I had a discussion where they looked at our technology and conceded that yes, there's much more thought than they had originally thought. So they're moving forward with us.
Yeah, I guess imitation is the highest form of flattery, right?
Yes, indeed.
And we had a couple of questions from participants on the customer angle, and I think that's something that we're particularly interested in here at CGAP. So Antonique raised the question of whether we had done any customer research to understand the effects of access to smartphones and levels of indebtedness. And somewhat similar to that, Audrey chipped in asking whether or not either CGAP or PayJoy will be conducting any research to test the effects of smartphone financing on financial outcomes, such as access to a range of products, usage of these products. On the former question, just from the CGAP side, I know that we actually did speak to one of your colleagues, Tom, at PayJoy about the possibility of digging a bit more into the impact of smartphone financing. But as of now, we haven't actually done any on the CGAP side. I wonder whether you have anything you could share about what you're seeing in terms of impact on customers or even on levels of indebtedness.
Sure, I really appreciate that question. In terms of levels of indebtedness, it is something that we do pay attention to. We do want customers who are able to pay. So if you look at, we internally at PayJoy, we tend to look at our alternative decision-making criteria is who's able to pay, and the lock in the app is as willingness to pay. And we definitely do look at ability to pay. We also limit our phones to one per customer. So that's, and we work with them. They can choose their own term. As an example, 3, 6, 9, 12 months, most typically, depending on the market, that cadence could be weekly, it could be monthly, and folks can always pay off the device early. So we do pay attention to that. But I also want to make sure I speak to this because upon your asking the question, I realized I neglected to mention this earlier, and it's quite important. PayJoy has been effective in bringing consumers who didn't previously have access to credit into the formal banking system. And we even see this with, it's not something that the consumers often readily want to speak about, but we do have a couple of anecdotals that I think are illustrative. We've seen people who haven't had access to credit before pay off their PayJoy loan. We send the positive off to a credit bureau to the extent one exists, and they suddenly are able to get things like a credit card or things like loans on there was one example of a loan on a motorcycle. And so you see these things starting to happen, which all, of course, have very positive effects as well.
Thanks, Tom. I'm just trying to keep up with all of the questions coming in. Please keep them coming. So one question, and I think that this is actually really interesting, kind of going back to the beginning of the presentation when we talked about the way that PAYGo Solar actually was kind of the initial inspiration for this approach. I mean, you were talking about how one of your founders was actually an early mover in the PAYGo Solar space. We had a couple of questions about the kind of synergies between PAYGo and PAYGo Solar and the products that you're offering, Tom. So I'm wondering, from Ardan, he had asked, could you please elaborate on the current and potential business opportunities between PayJoy and Solar PAYGo in the context of Africa? How can a $40 to $50 smartphone relate to financing of a $600 system? And I know that you are working with some PAYGos in Africa specifically, so I'd be curious to hear your thoughts on that.
Yeah, indeed. I mean, if you were to look at the Venn diagram of the consumer segment that PAYGo serves, the overlap is 100% with PayJoy, right? So what we've seen are these PAYGo systems accessing that same consumer segment and their know-how in that consumer segment and their ability to reach that consumer segment, let's call it from a retail distribution aspect, and making it work and doing so in a way that's really very beneficial not only to the folks that are getting the device, and incidentally, the devices are a little bit more valuable than the $40 to $50. It's a better device than that. Although it doesn't pass 100 US. It's also something that's been very beneficial to the PAYGo companies' portfolios because, again, they have this new asset class that they can bring to help diversify their portfolio of products that they sell on finance. So it's a beneficial, certainly, both ways, all three ways, for PayJoy, certainly for the PAYGo Solar company and for the consumer. I see a question here about how do we bring a new OEM onto PayJoy. I appreciate that question. If I could, I'll just answer that very quickly. It's actually what I spend all my time on, or most of my time on, in PayJoy. So we've got a number of brands that we're compatible with today. It can work on any Android device. And if there's an OEM that's interested in working with us, you can put them in touch with me, and we will give them a chance to review our proprietary source code. It's a piece of code that we call PayJoy Access. It works as a firmware patch. It goes down into the firmware, and essentially it makes all the devices that have this technology embedded in their firmware compatible with the PayJoy main locking app, if you will. So that means that the trade doesn't have to manage a separate inventory of PayJoy compatible devices. They just know that brand, or if you will, that model is PayJoy compatible. They can sell it as they normally would because PayJoy Access, this technology that makes the phones compatible, it's completely dormant unless and until the main locking app is downloaded onto the phone at the point of sale. So that essentially wakes it up, and that makes the phone a device that's sold on PayJoy or PayJoy facilitated financing. What else should we look at here, Max?
Yeah, so I saw a couple of questions around pricing and interest rates, and so I think one of the things that we had that we've kind of remarked on is in several markets, there's always the pricing and risk is always kind of a complicated process, and it depends on the various markets and sort of context. But one of the things that we have realized is that in many markets your rates are quite competitive compared to some competitors. And I'm just curious about how you set pricing, interest rates, especially when you're dealing with kind of various partners, various markets. If you could just talk a bit about that, I think that'd be interesting.
Sure. I think the best way to say is that PayJoy typically leads by example in the Mexican market, right? It's important for us to have that lab there, if you will. And we can show people how we've got a very competitive, it's a multiple, we call it in this space, relative to some of the other very well developed and very almost ubiquitous offers that exist out in Mexico. We find ourselves to be somewhere between 20 and 50% less expensive, depending on the term, than some of those competitive offers. And the other thing, I've said this before, I'll say it again, it's really unique about PayJoy, is that we have no fee or fine for a late payment, and that's simply unheard of, right? And I think it's one of those things that's driving that very high 80 net promoter score. So we typically take our examples in our books, and if there's a new customer is coming on who wants to license the technology in Mexico, we will do that, or perhaps a license the technology more commonly in some other country around the world. We will show them how we do it in Mexico and bring them to the PayJoy University. We'll show them our books. We'll show them how we do our model. Of course, they're going to go back and they're going to look at their own cost of capital, their own margin expectation, and their own risk, and apply the PayJoy technology. And as you've seen with the use cases that I've brought here in the past 3 or 4 years, we've got a number of believers, and they see that you don't need a late fee. You can be more competitive than you might otherwise think you can be with this consumer segment, because your default risk is halved and made so predictable.
Yeah, I mean, Mexico is such an interesting market, right? Because you have kind of these billion-dollar lenders who are out there, that are offering smartphone financing already, but again, without the locking technology, without your scoring algorithm, and who are charging rates, as high as 300% annualized. So it's certainly really interesting how PayJoy has kind of shaken up this space. Just a related question that just came in, also on pricing. So Anne-Marie mentions that when it comes to PayGo Solar, the business model really depends on having systems worth at least $150 in order to make the model actually sustainable, in terms of installing the lockout technology, et cetera. So Anne-Marie asks, how is it that you're able to do this with devices that are worth as little as $50? I don't know if you have anything you could share on that.
Sure. I'll just hasten to point back to it's $50 is not by any stretch of the imagination our average, and she's quite right. There's the math there that begins to get challenging the lower the price point is. However, our average is not 50. It's much closer to 200 today. We do offer phones that are for much less. In fact, I think, sorry, I'm just doing a quick conversion here. There are a couple that are in the neighborhood of $60 to $70, even $80 at a certain scale, and with the right combination of inputs into your formula, you can make it work. At the moment, we are growing in our portfolio of OEMs and models, and we do see that our average is substantially higher than the amount that she's thinking. And I think, let me just take a step back and sort of reinforce a certain message here. Our consumers that are on PayJoy typically do not go for that entry-level $40 to $50 smartphone as a rule. They'll see now that they've got the purchase power, the ability to move up market a little bit, if you will. So they're not going for that $50. They're going for the $80 or $100 because now they can. And there's a world of difference in the user experience, if you will, between a smartphone that's got that retails for $50 and one that retails for $100. You're going to have an exponential increase in the usability of that device, much more cleaner, and the consumer is much more likely to use it, and it's also going to be better able to consume data, as an example. So that's also an important criteria.
And you mentioned consuming data. For many customers, who may be perhaps getting a smartphone for the very first time, it may not be readily apparent that what you can actually do with a smartphone, sort of what the value of this device can actually be. And I would assume that would have implications for sort of the willingness of a customer to repay, the fact that how much they value this. So Chris Emmett actually raises the question of, do you do anything to try and maximize the value of the phone for the consumer, or does the consumer grasp this without any sort of digital literacy training? Are you doing any sort of capacity building to help customers to understand how to get the most out of their phones?
Yeah, that's a great question. And the simple answer is no, we don't, because we find the consumer really already values the smartphone. They really do get it. So I guess maybe it's just part of our global culture now. Most folks will realize that there is a huge amount of productivity that come from internet access and the ability to use these devices. That we do say, I'm a little bit hesitant to throw this figure out because I think we should do a better job of measuring it, but it's a little bit challenging to measure this. We see anecdotally, sort of broad brush, about 30% of our consumers are graduating from a feature phone to a smartphone. And so if you think about the impact that could have on a person's life, right? I mean, it can be profound. And we have heard that, from the point of sale, that there's not a whole lot the salesperson needs to do to convince somebody to move from a feature phone to a smartphone. Folks really do understand the impacts. Since I said the 30% number, I was in eastern Mexico doing a market tour, maybe hit about a dozen stores, and one after the other told me that the number for people graduating from feature phone to smartphone was actually somewhere in the neighborhood of the 60 to 70% range, and this is a fairly rural area. But I think, again, it speaks to, number one, the power of this kind of solution once brought into the hands of the consumer, and number two, how well the consumers appreciate and demand smartphones. Right, a lot of folks are graduating, and it's heartening to see.
That's incredible, 60-70%. I mean, especially looking at all the challenges that come with trying to get anything done on a feature phone. I mean, here at CGAP, we're obviously big proponents of digital finance, and using USSD menus on a feature phone is not exactly the most user-friendly experience. So having customers who have access to these more rich user interfaces, I think is also something that's really important from a financial inclusion standpoint. So that's really heartening to hear. Going back to kind of the customer angle, and I know we had discussed this a bit, before the webinar, Tom, but we had Jennifer who was mentioning that the credit algorithm seems like it's just as important as the locking feature in terms of getting customers improved and going through this underwriting process. And she mentions this gender gap that exists in smartphone ownership, which is certainly something that's high on our agenda. Do you happen to have any sort of information on the number of women who have been served or approved with PayJoy versus perhaps other providers offering smartphone financing?
Well, I certainly don't have a benchmark, and I don't have prepared numbers with me at the moment. It is certainly something that we are attuned to as well. We do have, again, and this is just anecdotal evidence, so pardon my hesitation, but we do know that when we see the kinds of use cases where we're graduating folks from a feature phone to a smartphone, that 30% or perhaps even higher in some of the rural areas, again, anecdotal, I would love to have more quant on that, but there it is. we tend to see that device will be, or we hear of that device being shared in the household. So perhaps the kids using it at night for homework and research, and a breadwinner using it during the day, that sort of thing. The other thing that I'd point to is that, again, we've got the limit of one device per person, but we do see a relatively high and, again, heartening percentage of people coming back to us to buy a second smartphone, and one can only assume that would, of course, increase the family sharing. So we're attuned to this topic, of course, as well. We are probably, I think it's fair to say that we're looking to answer the question of access writ large. Certainly, we'd like to get to a point where we can answer more fully that question of access for females and addressing the gender gap as well.
Yeah, we'll certainly be really interested in learning more about that as you dig into it, and obviously happy to help out in any way that we can. I know several of our colleagues here at CGAP are really interested in this question. One thing that I think we run into when looking at asset finance more broadly is, if the asset isn't working, people are not going to be paying. I think that just kind of holds true no matter where you're working. And so I'm curious, what sort of insurance or warranties do you include insurance or warranties with phones that you're financing, so that, if, say, the screen breaks or, something else happens to the phone where the customer is unable to use it, that they're able to get that repaired so they continue to make payments? I don't know if you bundle that in with your financing?
Yes, we do. In Mexico, we tend to leave that up to our partners and other countries, but it is something that we do include in Mexico, yeah. Right, and we do it for the very same reasons that you say, that your risk profile is going to increase if you've got that level of protection, if you can fix a screen, et cetera.
And maybe a somewhat related follow-up question. So one of the products that PayJoy is offering, that you mentioned, are these follow-on loans that use the phone as collateral. So it's sort of like a lease back, where once you actually paid off the device and you own it, you can actually take out a cash loan using your phone as collateral. The phone is then relocked, and you repay that cash loan in the same way that you paid for the phone in the first place. We're just curious, how do you value those cash loans? Because typically after, say, a year or so of smartphone ownership, the value of that phone is depreciated quite rapidly. So do you base the amount of that cash loan on the actual market value, the resale value of the phone, or do you use another method for valuing those loans?
Yeah, and we're just really experimenting with this at the moment. We see it's exciting. Certainly, the residual value of the device itself is taken into account. It's not the only thing. There is, if you will, I'll throw out the term, an emotional value of the phone as well. That said, they're typically not amounts that would be very large. Think $25, $50 range. Even still, I get it, after 12 months or so, the residual value would probably be a little bit less than that. But again, we see that this has been effective in some of our early tests.
Great, thanks. And just to remind, John was asking which countries in Africa that you're currently operating in. I know that you had earlier put up a slide, and I can try to scroll back to that, but I don't know if you know off the top of your head. Otherwise, I can try to
memory here. It's Senegal, Cote d'Ivoire, Nigeria, Kenya, Tanzania, Zambia, and we're just launching in South Africa, and we just launched in Madagascar.
Great. So definitely on the move.
Yes.
And then a follow-up question to that: Who are your partners in Zambia? We actually visited with one of them last year, or the year before last. But I don't know if you're able to disclose that, or if that's confidential.
I think they're still in a little bit of stealth. So I'll invite folks to Zambia, and we take them out there. Okay,
so it will maybe be announced in the future, but definitely, based on our visit to Lusaka, you guys are definitely active there. Interesting question from Maria on recovery measures, and I know that this is one of the big benefits of the lock, right? Is that you don't necessarily have to immediately go out and start knocking on people's doors to repossess an asset. Do you ever pursue recovery measures if a payment isn't made after a certain amount of time, and if so, sort of what's that threshold? What's that trigger?
I mean, we will call the consumers, as an example, call the users. But it just hasn't been a big enough issue for us to feel like we have to go out and look for the devices. Frankly, it's just not part of our common practice. It's not necessary with the lock.
Yeah, and I'd imagine that, especially when you're looking at the lower end devices, that the cost of repossession is probably, probably higher than the value of the device itself and its residual value on resale secondary markets. There was a question also about productive use, and I think that this gets a bit into kind of our interest in doing a bit more research on how customers are using smartphones and what the benefits are of smartphone ownership. But there was a question regarding how customers are using these phones. Do you see customers using them for, say, for their jobs and working in the gig economy or other sorts of productive uses?
I mean, anecdotally, again, yes, we don't really track it to be able to answer that question fully, but I can give you anecdotal, if you will, accounts. First of all, there is that access to more broader credit as well. Certainly, we do see a number of, you think about your Uber drivers as an example, we do hear a lot of that. How much more can I talk to that? No, I just don't have a whole lot of numbers on that. Other than those two examples, they are fairly common examples. I mean, you talk to folks who maybe are coming into a store in Mexico to make a payment, and you ask them how you use the phone, and of course you get the same answers as everybody here on this call would use them for social reasons and keep in touch with family and friends, and work purposes do of course come in, and that could be just as simple as having the boss call you, calling the boss, or actually working in some kind of a gig sector, as you had mentioned. But I wish we were able to give a more definitive answer to that question. We simply just don't track the phone. Much more interested in bringing access and then letting the consumers find the uses that they find most efficient.
No, that makes complete sense. And so thanks for being game. I know we've been hitting you with a barrage of questions, so I'll go ahead and make this one the last one. So one kind of question that came from one of our colleagues here at CGAP was, how do you compete with unsecured credit? So say somebody who just gets an unsecured cash loan and then goes to the nearest distributor to buy, or retailer to purchase a smartphone using that cash loan. How do you compete against that or position yourself against that?
Yeah, well, typically that cash loan, that unsecured loan, will come at a much higher interest rate than a PayJoy facilitated loan would. So that's the first method, right? You say. Secondly, as well, oftentimes those cash loans don't come with the kinds of flexible payment rates that you might have with PayJoy. The process with PayJoy, if you will, and this is guided by our point of sale process. That's a web service as well. There's a conversation that is prompted, and the vendor or the clerk will share with the consumer who's looking to purchase the phone. Here's your terms: 3, 6, 9, 12 months, whatever the cadence may be, weekly or monthly. This is what your payment would be in each of those terms. Which is the most convenient for you? If a consumer goes and gets a cash loan, not only is it going to be more expensive to get just by virtue of it being an unsecured loan, they're not going to have that flexibility of payments and term. That they'll already have locked themselves in to that term and that payment, and maybe they won't have as many options as they might otherwise have with PayJoy.
That makes a lot of sense. So we're coming up right against the end of the hour, and so I think we'll go ahead and close things out. I want to thank you again, Tom, for joining us today and for sharing this really exciting information on PayJoy's business model. I think this is something that we'll certainly be keeping an eye on in the months and years to come, and are looking forward to continued collaboration with you and your colleagues. Just a reminder to everybody on the phone that we will be sharing out the recording of the webinar and the presentation. So you should look forward to receiving that in your inbox very soon. Thank you all again for joining us, and please feel free to reach out to either myself or our colleagues at CGAP through our website should you have any follow-up questions or would like any additional information either on PayJoy's work or on the work CGAP is doing in the asset financing space. So thank you all again, and have a wonderful day or evening, depending on where you're joining us from. So thanks again. Thanks, Tom.
Thank you. Great to be here. Appreciate it, everybody.
Take care. Bye.